Hey there, NIO fam. Hope you're all charged up and ready because today's story is a big one, and it's got investors buzzing. NIO's back in the spotlight, this time over a brand new lawsuit that's raising old questions. But don't worry, we're breaking it all down. What's happening, how it could affect NIO's stock, and whether investors should be concerned or not. So here's the scoop. NIO shares listed in Hong Kong and Singapore plunged on Thursday after news broke that Singapore's sovereign wealth fund has filed a lawsuit against the company in U.S. courts. The fund isn't just going after NIO, it's also targeting CEO William Lee and former CFO Stephen Feng, who left the company in July 2024. Now, this lawsuit isn't about something new. It actually digs back into allegations made 3 years ago by short seller Grizzly Research. Back in 2022, Grizzly claimed that NIO had inflated its revenues by as much as $600 million in 2021 through its battery asset management arm, Weineng. Here's how that worked, according to the allegations. Weineng, which was created to manage NIO's battery as a service program, supposedly bought up all of NIO's leased batteries. That move allegedly allowed NIO to record the full value of those battery sales up front, making its revenue look higher than it really was. Singapore's wealth fund is now echoing those same claims, saying NIO used Weineng to inflate its financial results. But NIO isn't taking that quietly. The company fired back, calling the allegations false and misleading. In a statement shared with EV Media, NIO said this is not a new issue and has nothing to do with the company's current performance. NIO emphasized that an independent internal investigation was already completed back in 2022, led by international law firms and forensic accountants. According to NIO, that investigation found the short seller's claims had no factual basis at all. The company insists it's always followed compliance and corporate governance rules across all three of its listings in the U.S., Hong Kong, and Singapore. NIO also took the opportunity to defend its battery as a service model, saying it continues to deliver strong value to customers. The company highlighted that the BaaS system, which allows drivers to swap batteries instead of buying them outright, helps lower upfront vehicle costs and extends battery lifespans. Despite the reassurance, investor sentiment took a hit right after the lawsuit became public. As of the latest update, the stock was still down about 3%, trading around $6.61. Now let's talk about what all this means for the stock. Short-term volatility is almost guaranteed. Legal headlines like this, especially when they involve big names like Singapore's sovereign wealth fund, tend to shake confidence even when the claims are old. Traders may see more pressure on NIO's share price until the legal situation becomes clearer. But for long-term investors, this might not be as serious as it sounds. Remember, these allegations have already been investigated internally, and no new evidence has been made public so far. If that remains the case, NIO's fundamentals and growth strategy likely won't be affected. That said, perception matters, and this kind of story can linger in the market's memory. For now, investors will be watching closely to see if the lawsuit gains traction in court or fades like previous short seller claims. Alright, that's the full breakdown. What do you think? Is this lawsuit just noise, or do you think it could cause deeper damage to NIO's reputation and stock? Let me know your thoughts in the comments below. And if you found this update useful, don't forget to hit like and subscribe so you never miss a beat in the world of NIO and EV stocks. Until next time, stay charged, stay smart, and I'll catch you in the next one.